Well, I have Rene back because Rene, he knows stuff about the market and about stuff out there that you don't know about, I don't know about, places to go, things to see. And so he was on just the other day talking about the issue of commitment and how options apply to that. It was a phenomenal video. If you haven't taken a look at it already, I will put it in the description below, a link so you can go take a look at that. But Rene, thanks for coming back.
Thank you, Randy.
Today, I want to do a little round robin with Rene. I want to hit him with a bunch of different stuff that's going on and see what he thinks about these things, including about Tesla stock. So, if you're up for that, I'd love to get into it, Rene. Let me look at my notes here. So, here's a kind of another one that I think would be right up your alley. The bonds inversion. It's been going on for a year now. They've been inverted for a year. Everybody says that's evidence of a coming recession. Apparently not. I've been saying for 7 months that I don't think it's evidence of a coming recession, and that I think it had to do more with really smart investors trying to lock in that 10-year. And some of them even wanting to lock in the 2-year and the 2-month. But the inversion, some people look at the inversion as being the 10-year versus the 2-year. Some also look at the 10-year versus the 2-month as the inversion, but both of them have been badly inverted for a year. First question is, why do you think that the inversion happened this time? Do you have a different take than I do? And second question is, it last 3 days, the inversion seems to be inverting. Is that a signal? Is that something we should be paying attention to? How long does it need to continue that trend before we should pay big attention to it? It's all yours.
Well, I want to answer it with a counter question. How should the yield curve look like in your opinion? What's the normal way of looking for a yield curve?
Should the yields look compared to one another?
Yeah. For example, the 10-year and 2-year, how should they look like in your opinion?
Well, you should have a lower interest rate on a shorter term loan.
Yes.
Than you and a higher interest rate on a lower interest rate on a short term, and a lower interest rate if you're going to go out. Higher interest rate if you're going to go out. Yes.
It should be hard. Sloping,
the whole bond thing. You know why people don't trade bonds? It's because it's so darn confusing.
Yeah, I mean, it is.
Right now, if people are running away from the 10-year, right? Well, the yield is going up. So you're like, well, the yield's going up. That means people are running away. Well, they're not just buying as much, or there's too many bonds being offered. It's all backwards. And so it's really hard for people to think that. Okay, so anyway.
It should be upward sloping.
Yes.
Higher, longer rates should be higher, right?
Yes.
The question is then, why would that be?
Yeah.
Have you ever thought about that?
So if I'm going to loan my money to somebody for just a couple of weeks, they're going to be in and out in a short term. There's not as much risk. I know their financial situation before I loan them the money, so I feel better about that, so I can charge less. But if I'm going to loan it for 10 years, who knows what could happen? They could die. I mean, who knows?
The U.S. government probably won't die, but
no.
So, and what will change that then? If their credit quality increases or decreases, that will then, of course, change the interest rate. So
yes.
The longer you commit your money, the more interest rates exposure you have.
Right.
So if you have if you buy a 1-year bond and the interest rate changes by 1%, it barely moves.
Yeah.
Right. If you buy a 20-year bond and the interest rate changes 1%, you can lose 20%. Right. It's almost like a 30-year. I did that analysis a while back. A 30-year Treasury security has the same volatility as the S&P.
Oh my God!
Over time. So then it becomes very risky. And investors, they of course do not want volatility, right? You have to pay a premium. You require a premium as an investor to be exposed to volatility. Right. And that's why longer term bonds need to be lower valued than shorter term bonds, which then in turn causes higher interest. Right?
It creates the again, always thinking about the fact if the bond costs less, which means people are not as interested in the bond, that gives a higher interest rates or yield. And so when people are bailing out of a 10-year right now, apparently, or where there's way too many the treasury is offering way too many now or shortly. So people are saying, oh my gosh, that's going to cause it to go down in value. Then the yield goes up. And it's really hard to keep that in your head. Anyway, go ahead.
Exactly. And the question then is, so this is called the term risk premium, by the way, right? It has a term.
Okay.
So why would the term risk premium then be negative?
Yeah.
Why would someone pay more for a long-term bond and less for a short-term bond?
Yes.
Right? So the only reason that comes to mind is they expect yields to fall, right?
Right.
So the market participants, they have a consensus, yields will come down.
Right.
So you have to pay a premium in order to secure current interest rates for a long time, right? So this inversion, it doesn't just say the short-term rates are too high. It even says the long-term rates are too high. An inversion says the entire yield curve will come down, not just short-term. That's important. And it has signaled turning points in the yields, in the 10-year yield, very well in the past. Maybe I can share one of the charts that I did with that, and you can show it here when you upload the video. So in like the last 6 instances when there was inversion, 5 times a year later, yields were much lower, right? And there was an exception.
So it's predicting. So what it's really predicting is that interest rates will be lower, and that could be a signal that there's going to be a recession, because recessions tend to be disinflationary, which would tend to have yields go lower. So it could be a predictor of that, but it's almost always going to be a predictor that future interest rates will be lower. Or let's say that the crowd is betting that.
Exactly. So that's what you just said is very, very important. An inversion does not cause a recession, right? When somebody says it's completely like it makes no sense, right? It does not cause a recession. It can signal a recession because an inverting yield curve says yields will come down, and that basically means inflation will come down. And inflation comes down, and for 2 reasons inflation can come down, right? Demand weakness, which is recession, or strong supply. And that is what Casey Wood talks about, like the deflationary boom, right? Because innovation.
Productivity.
Yeah, productivity, right? Higher productivity, inflation will come down. And that's why she says we will have an inversion. It's just demonstrating that the economy will have innovation driven or disinflation, deflation, whatever. Yeah. So but I want to focus on this recession indicator. So it can at maximum be a secondary indicator, because it simply says rates will come down. Second, it says maybe because inflation will come down. And then potentially that can be demand driven. It can be a recession, right? So yes, in the past, this has correlated, but by no means it means inversion equals recession, right? You have to always look at the entire picture. So, and then the question is, you still talk with your second aspect was the inversion of the inversion, so to say, right? So the yield curve is steepening now, but it actually means when it's inverted and it becomes steeper, it actually flattens, right? So,
right.
I hope that makes sense. Well, we're seeing the long end selling off really hard, right? The 10-year, the 30-year, and I wrote about that already for the entire year, basically, right? I've said long-term bonds, very bad investment, right? Stocks like long S&P, short TLT, it's a wonderful pair trade, has been for the entire year, and the reason for that is many investors have bought bonds over the past year. If you look at the Bank of America Fund Manager Survey, it surveys fund managers that manage $700 billion, so very representative sample, and what they own compared to historical levels, right? And then it quotes it as standard deviations of a historical average. So, for example, if you are one standard deviation above your historical allocation to bonds, it means that you have currently more bonds than in 68% of the time, if you remember that from your math class in school. Yeah. And so that was -1 standard deviation before the hiking cycle started. And now it's +3 standard deviations. So if you can assume that it's normally distributed, the allocation, investors' allocation to bonds, right? That happens in like less than 1% of the time. 3 standard deviations, right? And basically, they're as long as they have ever been in the last 20 years, right? So they have bought the dip very, very hard on bonds, right? So, and that's why how they contribute to avoiding the worst for the treasury market, right? But they can only do that once, right? They have invested so much into bonds and took that all out of equities and from other sources. They have as much bonds now as they could possibly want. They don't want more bonds.
And now the treasury is going to be flooding the market with another bond offering, one of the biggest ever.
Exactly. And it's not just one offering. They're running a fiscal deficit of $2 trillion, right? So that is COVID emergency spending still here, 2023, without a recession, with low unemployment, with a decently performing economy, not like falling off the cliff 2008 style. Right. And they are running like a 6, 7, 8% deficit. They need $2 trillion from investors around the world and domestically every year. And the Fed, that has been a major buyer of US Treasury securities, is not buying anything right now. In fact, they're selling, they're net sellers. And so Janet Yellen is basically selling all these debt security, these Treasury securities into a void. Right? There's nobody there. And that's why it sells off.
So again, let me just restate it because it went a little fast there. So basically, guys like me and you who might be bond buyers, especially in my 401k or something like that, I might have it managed, and they might be buying treasuries or money markets or whatever. There's a certain amount of appetite for that from all the institutions, from all of the 401ks. There's a certain appetite for bonds, and what you're saying is historically it's maxed out. The appetite for bonds. There's no more liquidity to come into the bond market because the folks that buy the bonds, they're tapped out.
Exactly. If you think, you could even call it a bubble.
A bubble.
It sounds absurd to call a bond bubble after the bond bubble burst.
Yes.
But a bubble should not be defined by price. It should be defined by its size in investor portfolios, right? If that is too high, then it's bubble.
I see.
So, yeah, it's just there's and now all these bond investors are being hit. They are facing an economy that seems to accelerating. Like we have a cyclical impulse right now, and more they will realize, oh my God, the corporate earnings are holding off. Yes. Maybe they're getting even better from here. And by the way, why are corporate profits improving? Because of the fiscal deficit spending that puts the money from the treasury into the pockets of the companies. Right. So Janet Yellen she needs people to buy her bonds, but by running these fiscal deficits, she chases them away into stocks, right? And so these people realize, okay, 4%, maybe even 5% at some point is not so great if the S&P pumps beyond 5,000. And I think that's what happens right now. So I'm not sure if people are running from bonds, but there are two things that are problematic. First of all, there is so much debt supply that cannot be bought by the market, especially while there's quantitative tightening still going on. Right. And corporate profits are holding up well, and people realize, oh, we have too much bonds in our portfolios. We need equity exposure as well because the big bust is not happening. And I think that's so right now.
So let's look at what everybody's calling the Cinderella environment. So we have a situation where labor is great, People are employed, they're making lots of money. It looks like the S&P it looks like the big corporations are doing okay, and as you said, getting better. I made a big argument, which I'll bring up a little bit in more detail in a second, about productivity is going to be gaining big time has already started with the second quarter productivity gains like this, and no reason why productivity won't continue to gain big time over the next 12 months. So if all of that is true, and inflation, according to Truflation, is in fact, according to everything you look at, inflation is coming down radically. So that's a Cinderella situation if you'd ever want to talk about it. So how can yields stay up in an environment where inflation might be going to zero?
It's a pain trade right now. It's a pain trade because there are too many people buying bonds and they need to feel the pain. And there will, at some point, bonds will have to come down to reasonable levels. I think they are way above where they could sustainably be, but that doesn't matter in a pain trade.
I see.
People first need to capitulate. People need to accept that bond yields will remain high, elevated, and won't come down quickly. And
All
then
right.
they will come down.
All right, I think I've got it. Okay, so what's got to happen, and what I'm talking about in terms of 2 or 3 days now in a row of the inversion inverting, that could be people who love bonds who will be selling their 2-year and their 2-month and buying 10 years.
Well, the 10-year is actually selling off. Well, I haven't followed what happened in the last days, but I thought the long end is selling off.
No, the 10 has been going up, and the 2-month and the 2-year have been coming yields. I'm sorry. The 10-year yields have been going up, and the 2-year and the 2-month yields have been coming down. That could signal a rotation back to a normal viewpoint, and it would still be in the bond market where those people are selling off the short-term ones to buy the long-term one and try to get that yield while they still can.
Okay, well, we need to be careful if we're talking about yields or about prices.
I know.
Yeah. So when the yield curve, when an inverted yield curve becomes flatter, right? It means that the long-term bonds yields are going up and the short-term bond yields are going down, right? That means the long end is selling off.
Right.
The long end yields going up means the long end is selling off.
Yes. I'm sorry. Yeah. So just a second. Let's so that I'm not confusing you or the folks that are listening. Let me just go to. All right. So to be clear, I probably said it wrong. No, the 10-year is very strong right now, which means there's no demand, right?
The 10-year yield or the 10-year bond?
The 10-year bond, the yield is going up.
So the bond price is going down.
Bond price is going down, where on the 2-month and the 2-year, the price is going down. The yield, is going down, which means that the people are bidding those.
Yes.
Bidding those up.
Yeah.
Okay, so they're still
people are selling the long end. People are selling the long end. Part of that is probably that the economy is doing well, and so you can also think about it from a duration perspective. If you invest into a short-term bond,
right,
your alternative is cash, right?
Okay. Right.
If you invest into a long-term bond, the alternative is stocks, right?
Okay.
Because you want the same duration, right? Why would you buy a 2-year bond? Because you need to park the money for a couple of years or months, right? Why do you buy a 30-year bond? Because you want to invest for 30 years. So the natural alternative would be buying stocks.
Got it.
Right?
Okay.
So when corporate earnings are positive, have a positive surprise, people shift from long-term bonds to stocks.
Okay, but there should be. But I think what I was trying to say earlier, I think I said this right, even though I might have used the wrong words. At some point, people will be wanting to own the 10-year in order to capture that 4% interest rate. And they will anticipate inflation going down over the long term. And so there might be a rotation out of the shorter term bonds. So those rates will go up to where they should be because people are selling them, and they'd be selling them and taking the cash and putting it into the 10-year or the 30-year.
And that is exactly what has happened over the past year, which is why we had this inversion to begin with.
I see.
Yeah.
So we would expect then this trend would be continuing as inflation continues down.
Yeah. So there's a principle in investing, it's called reflexivity. So what people expect can impact prices. So if something becomes too obvious, if an investment case becomes too obvious, it dies.
I see. Yeah.
And the whole idea about disinflation bringing yields back down became so obvious to people with these inflation prints coming down,
yes,
that everyone bet on it. And now the opposite happens. And I don't know whether that takes 6 months or a year or 2 years, but I know that there has to be pain in the long duration bond market. There needs to be a capitulation of people buying long-term bonds. Once you hear that on social media, that many people, like, look at the large accounts, the large FinTwit accounts, when they say yields will remain high and this is a new paradigm, that may be the time when the bond bid happens, but it's not now. Like this bond scare right now is a buy the dip opportunity, but not for bonds. It's a buy the dip opportunity for stocks.
I got it. Yep. All right. So let's talk about productivity for a second. I've been making a big deal about it on my channel. I've always thought that the real measure of an economy is productivity. A measure of a company, Tesla, one of the reasons it's so strong is because it has such high levels of productivity compared to its competition. Countries like the United States are doing as well as they do because we are so much more productive. We get so much more goods or services out of $1 of labor. And what we're seeing right now is we had 2 years of really low productivity because everybody was scrambling just to find enough labor, or they were scrambling to find enough ways to move their goods from point A to point B, or they were scrambling just to get the goods because there was no goods to get, or they were scrambling to buy a part that they couldn't find anywhere and they had to air freight it in. All of those things are the opposite of productive. And it also doesn't set up a company. It does, the C-suite is not going, oh, how can we automate right now? Oh, how can we become more productive? They're just scrambling to stay alive and to keep the commerce going through the system. And so productivity crashes. And now that things are normalized, productivity, now the C-suite is going, okay, things are normalized. We need to buy that computer. We need to buy that NVIDIA chip. We need to buy a robot to go in our factory. Anyway, we need productivity things, but we also need to make our people more productive by training or by systems analysis or whatever. Am I getting this right?
Yeah, I actually watched your video on this the other day. So I found it very compelling, and it kind of fits with my assessment that we're seeing the cyclical impulse right now. Like we're early in the business cycle, and we see now these productivity gains. We're still in the aftermath of this big disruption that we had a couple of years back, and monetary policy right now is hiding this because people think, okay, the cycle ends when they start cutting, but they are like even more behind the curve than they usually are. So we are probably early in this process. There will be a cyclical, and we'll have a I don't know what will happen, but I'm trying to assess what's likely to happen. And it seems plausible to me that we'll have a very rare instance of a cyclical impulse alongside rate cuts, which is like rarely happens, right? But if you think everything through, for me, it's the most logical thing, right? We will see an uptick in automotive, we see an uptick in real estate, like all these transactions that had to happen never happened. There's so many millennials, they need to buy homes right now. And their corporate profits will probably hold out well for the reasons you outlined. And then, this productivity increase will also provide economic growth without much inflation, that the Fed will have to cut rates, right? Alongside an economy that's actually accelerating. So it's pretty wild setup, but it's the plausible scenario for me.
So I'm looking at the trueflation curve here. I mean, how does the Fed look at this and not think that inflation is going to continue down? I mean, I understand it could find a place where it's not going to continue down, but if they also have the second quarter that just printed with regard to productivity, and they got to understand that productivity and inflation are the inverse of one another. I don't understand why they don't think, aren't pretty clear that inflation could easily be going towards zero.
Yeah, it's difficult to understand. If you had told me 6 months ago, if you 6 months ago told me all the inflation prints for the next 6 months, and you quoted me today's Fed funds rate, I would have not have thought that is possible, right? But yeah, here we are.
Isn't it usually? Isn't the interest rate usually about 1.75% above the inflation rate?
Yeah, that's like a general rule of thumb that I also use for myself. Like, you shouldn't have, even if this may be a little bit distorted downward because we had this the commodity shock, the energy shock following the Ukraine invasion, and that's now falling out of this. This is a year-over-year rate. This is not the month-over-month or the current run rate. So there may be a bit of a distortion in the slope of this chart because it digested the oil price shock of early 2022, and then it was released from this chart. But even if you say, okay, let's call it 3%, we're at 5.25. I don't know it even right. I haven't followed in that detail anymore because it has become nonsensical for me. But it doesn't make sense to have a Fed funds rate 2-3% above where inflation is. So it's at least 200 basis points too high.
Yes. Yeah. So to your point, then we could see, if this continues, this slope continues, and we start to see that inflation really is cooked, you could see a Fed flip, maybe not in September, but maybe in November, where they actually have to cut.
Maybe, yeah. I've kind of stopped caring about it because it has become such a theater for me that these are overnight rates, right? These are not like the 10-year rates that determine like business loans or mortgages. So these are like overnight rates. It's a distortion in the money market. Whether or not these stay at these absurd levels for 2 months or 6 months, I think markets have digested this. Markets don't care about it anymore. You can see it even when the FOMC meetings happen. Their markets barely move. So yeah, I think it has become a secondary driver for asset prices. Yeah, we just have to wait until it normalizes.
Okay, so my last question is, what about this? We talked about it in our longer video with regard to commitment. People should watch that video. Okay, so, but what about correction? When are, other than the commitment charts that you showed us, and looking at the derivatives like the calls and the puts and whatnot, other than that, do you have any other things, any other ways of trying to see when the correction will come in this first leg of or second leg of the bull? Is there something else to look for on the correction? And second question related to it, there could be a rotation without a correction. So the techs are just, as I call it, out over their skis. Maybe not, maybe they're fairly priced, but the tech has gone crazy, whereas the dividend stocks and kind of the 401k stocks have not improved as much. Do you have signals that you would encourage us to look for in terms of either that rotation, some other rotation that maybe I'm not even looking for, or a correction?
It's difficult, right? Like, if you consider yourself an investor, what does it matter whether we draw down 5% or so over the next 2 months? Of course, can always happen. To me, it seems unlikely that we'll have a major correction right now. My suspicion is we'll have a sell the news event when the rate cuts start. Because that is exactly what happened in August 2019. So in December 2018, they said we need to hike further. 4 weeks later, they paused in January. By then, the S&P had run by 20% from like Christmas 2018 sell-off. And then it pumped the entire year 2019. And then in August, we had the big correction, which with respect to the S&P, big corrections are always a bit of a, like, as a Tesla investor, you are used to daily swings like that. Right. But when the S&P corrects by like 5 or 8%. That's pretty significant. And that happened in August, and right after the first rate cut started in I think July 31st of that year. And so that is, I think, when the rate cuts start alongside economic resilience, then the bull case becomes obvious enough to be compromised a little bit.
I see.
So and right now it seems like consensus, we'll have a correction now. Like, people just look at charts and they, okay, correction, but just because the chart goes up doesn't mean it's come down.
So the VIX is showing that there's still a lot of fear out there. The way I described it a couple of days ago was, we've got people that have either recovered their losses, or we have people that have some really nice gains right now. And so the fear is no longer that you're going to lose your basic fortune or your basic investment. The fear now is, oh, I've got this much. Should I trim? Should I take some off, or should I take it all off? And because maybe the market's going to fall apart for a week or a month. So I feel like the fear is, I hate to use the word transitory, but the fear might be momentary until there's enough additional news about the overall economy to kind of get that fear under control, so people can get more risk on.
Yeah, for every dollar that sits on 30% gains and is afraid to lose them, there is like 10 other dollars of people who sit in bonds or cash, or like incomes are also pretty solid. So people have continuously to invest. I don't know. I mean, I could look like a fool 4 weeks from now, but this doesn't seem to be like one thing is important. Like, a correction can happen anytime, right? I mean, that's why we paid 8% every year, because volatility happens and we need to be exposed to volatility to be able to earn this 8% return as investors over time. Right. So it can happen anytime. I'm not in the business of predicting like a 5% swing in 4 weeks. What I try to do is, with all this, like, people ask me sometimes, like, why do you put so much effort into your macro work when you never trade it? It's just simply for conviction building. What I want to avoid to buy Amazon in 1999, right? That's what I want to avoid, right? People still say, okay, Amazon, you bought it in 1999. 20 years later, you're still up 100 times. Yeah, but I kind of need to have some security for myself for the time in between. So I'm trying to understand if there is risk for like a big generational sell-off. Like, I don't care whether we'll have a 5% sell-off in 4 weeks. But having said that, again, I feel like a correction now seems to be too much of a consensus view, that I would be surprised if we see a major one now. Like, for me, again, the most likely scenario is that maybe there will be like a 10% correction in the S&P when the Fed starts its rates cuts.
I see.
That by the time we might already be above 4,000 and drop to 4.7. So yeah, we're now at 4.6. So
okay, I lied. I said I didn't have any more questions. I forgot that I promised my crowd that I was going to ask you about Tesla. So I continuously say, and there's a bunch of other YouTubers that say this all the time, I have never seen a better risk-adjusted opportunity in the over 50 years I've been playing the market. I mean, there's nothing even remotely close in terms of all these different divisions that could all explode into additional Teslas or even additional Apples, and not over 20 years, but over 7 years. I mean, it's just mind-boggling that people are not pricing in the energy thing, which I believe will be at 100 billion in sales within 3 years. I don't think that's an overly optimistic viewpoint, that they could have 5 factories like Lathrop making megapacks by 2026, and that would be $100 billion company in a situation where there's not even any volatility in terms of seasonality or ups and downs of markets. It's utility sales. So I don't know. It seems to me that this is like a no-brainer, and that the market still doesn't get it.
I share your opinion, of course. It's I think it's it's rare. I think it's difficult to imagine another company with a similar predictable growth runway that has such great investment opportunities at their hand. Obviously, they have these macro headwinds right now, but usually these kinds of stocks recover before you can see it in the financials. So you don't want to buy this when the EPS has started improving. You want to buy it before that happens, because like then the algorithm, they're already in it, and they like there are many sophisticated investors. They track information about deliveries and so on. So we have to kind of make a leap of faith. If you do your homework, it's difficult not to be very excited about it. Apart from the share price, I also don't see like irrational exuberance right now in the way it moves. So the most likely scenario for me is that it will grind higher, definitely.
And this is not investment advice.
For sure.
Homework. Rene,
and yeah, you have to bear the volatility, right? You have to be willing to like have like 60% annual volatility as opposed to 15% in the S&P, right? So that is something that unfortunately we need to accept that as part of our path that we've chosen.
I actually like that part of it. So don't tell anybody. Rene, as always, a great pleasure to have you on. Hit like if you want to have Rene back, and hit subscribe and notify, because you want to be notified the next time he's going to be on. And then, of course, follow Rene at fallacyalarm.com. See, I got it for once. All right, good. I got it now. And when you go to fallacyalarm.com, the main thing you want to do when you get there is sign up for the newsletter, because you're not going to get the stuff he puts out. It ain't anywhere else. This is stuff that is above and beyond. Nobody else is doing what Rene's doing. Thanks again, Rene, for being on.
Thank you so much, Randy, for having me.
And then for all of you out there, it has been great talking to you.
Click the link below to get your paperback, Kindle, or audiobook now.